ICICI Bank. Their latest 2026 results just dropped. And yeah, the headline numbers look pretty good. But if you look just beneath the surface, there's a really interesting strategic shift going on that could completely change the game for the bank. Let's break it all down.
So, let's just cut to the chase. You see strong growth, you see fantastic asset quality, and the temptation is to just slap a buy on it and call it a day. But is it really that simple? Well, that's the big question we're going to tackle right now.
Okay, before we dive into all the juicy numbers, let's do a quick refresher on what ICICI Bank is all about.
So, you probably know them. ICICI is a giant in India's private banking world. Their bread and butter? It's classic banking 101. They take in deposits, they hand out loans. But what's really key to our story today, and we'll come back to this, I promise, is their international footprint.
Now, one really big move they made this year was pulling their brokerage arm, ICICI Securities, completely in-house. And look, this is way more than just some corporate housekeeping. It's a huge signal. They're basically telling the market, we want to be your one-stop shop for everything financial, not just a place to park your cash.
All right, so how did all of that strategy actually translate into performance? Let's get into the Q4 numbers.
First up, profit. It's up a very solid 8.5% from this time last year. We're talking over 13,700 crore rupees for the quarter. You know, in today's environment, that's a really healthy bottom line.
And what's fueling that profit? Well, it's what banks do best, lending. Their total loan book swelled by a pretty impressive 15.8% year over year. They're definitely getting more money out the door.
But honestly, this is the number that should make you sit up and take notice. Their asset quality. The net NPA ratio, basically their bad loans, is down to a tiny 0.33%. Let me be clear, that is an exceptionally clean book, almost spotless.
And just so we're all on the same page, the net NPA ratio is the slice of their loans that have gone sour, after they've already set aside cash to cover potential losses. So the lower this number, the healthier the bank's assets are. Simple as that.
So we've got strong profits, great loan growth, and a squeaky clean balance sheet. It all sounds perfect, right? But here's the thing. A nearly 16% loan growth doesn't just happen across the board. It's coming from somewhere specific. So let's peel back the layers because this is where the real story begins.
And boom, this chart says it all. I mean, just look at that divergence. Retail loans and corporate loans, they're growing at a respectable 9.5%. That's fine. But then look at business banking. It has absolutely exploded with growth of over 24%. This isn't an accident. It is a clear, aggressive pivot towards small and medium-sized businesses.
But, you know, whenever you see that kind of high-octane growth, you have to ask, what's the catch? What are the risks? And I'm not talking about the standard boilerplate risks the bank mentions in its report. We're talking about the risks that are kind of hidden between the lines of the data.
So on the left, you have the usual suspects, regulatory changes, economic instability. Every bank lists these. But on the right, these are the implied risks you really need to watch. First, they're putting a lot of eggs in that business banking basket. If that sector stumbles, ICICI is going to feel it big time. Second, their loans are growing faster than their deposits. Think about that. That's a funding gap, which means they might have to pay more for funding down the line, and that can squeeze profits. And third, those international operations we mentioned, they're showing some weakness.
And if you want to see that third point in action, just look at their Canadian business. Operating profit there took a nosedive. We're talking from almost 96 million Canadian dollars down to just 36 million this year. That is a huge drop. So instead of being a source of diversification, it's actually a drag on performance right now.
Okay, so what we have is a clear pivot toward higher growth, but it comes with a higher risk profile. So how does all of this factor into the bank's valuation and our final call?
This number right here is the bank's safety net, its CET1 ratio. At over 16%, it is exceptionally strong. Think of this as the bank's capital cushion, ready to absorb any unexpected losses. This fortress balance sheet is exactly what gives them the confidence to take on these new risks.
And the board is signaling its own confidence too, recommending a dividend of 12 rupees per share. That is a clear, direct message to shareholders that says, hey, we're profitable, we're well capitalized, and we're feeling good about the future.
So when you put it all together, you have a powerful new growth engine, that pristine asset quality, and a robust capital position to manage the risks. Our recommendation is a buy. We believe this strategic pivot is a calculated risk, and frankly, the bank has the financial muscle to pull it off. So, we'll leave you with this final thought.
ICICI Bank is trading some of its traditional safety for a much higher speed of growth. The question you as an investor have to ask is this: have they found a brilliant new engine, or are we just seeing the start of a future problem? For now, we believe the potential rewards here far outweigh the risks.